Good evening. Welcome to our Georgia Tech Homebuyer Workshop. My name is Jason Maida. I'm going to be your host this evening. It's great to be with everyone. I appreciate you taking time out of your busy schedules on this Wednesday evening to join us for our class. This is our first of 4 installments of classes that we offer through the Georgia Tech Alumni Network. So really excited that you took some time out of your busy, hectic schedules to get a chance to join us for tonight's class. I know we're just a few minutes or maybe a minute past the top of the hour. We had a lot of signups for tonight's class. So I'm going to allow everybody to get in and get settled in the Zoom room, and then we'll go ahead and get started with tonight's content. Tonight is a very interactive session. So as I roll through tonight's content, really encourage you to ask questions of us. We'll be able to answer those questions. You can use the Q&A function within Zoom, or you can use the chat feature, whatever works best for you. I know our audience is kind of spread out all across the country, so we're going to try to diversify some of the content when we talk about market data for the housing market. And as we're thinking about kind of maybe where you're considering purchasing, it would be super helpful for me to get a sense of like where you're thinking of purchasing and maybe where you're joining us from across the country. So if you feel comfortable, drop in the chat where you're thinking about purchasing or where you're at in the country, because as we get a chance again to talk a little bit about the housing market, it'd be really helpful to learn a little bit more about where our audience is joining. I realize the Georgia Tech Alumni Network spans all across the country, so that would be super helpful to learn a little bit more about where you're joining us from. Tonight's class is going to be recorded as well, so we'll have this up on our YouTube channel tomorrow, and will also be sending out all the presentation material tomorrow morning. So not only will we be recording tonight's class, we'll also have the presentation material up on our up and available to you. So for signing up for tonight's class, we obviously have your email on file, and then we'll go ahead and send you out all of the content. All right. A little bit about our organization. So I work for a company called American Pacific Mortgage. So we're one of the leading mortgage providers across the country. We're a top 10 lender in the country. Our team here in our particular branch that services alumni partnerships like this, we're one of the top 100 origination teams in the country. And we have an educational platform that you're a part of tonight. So what we essentially do is teach classes like this all across the country through 15 of our alumni networks, and just offer education and resources to help you on that path towards homeownership. So a lot of what we talk about is centered around first-time buyer programs and just really resources and support that can help you as you proceed on this journey towards homeownership. Part of that includes some of these talking points tonight, which we'll be going over the housing market, like I mentioned earlier this evening. We're going to talk a little bit about what's going on with interest rates. I have a lot to share with you today, unfortunately, about the kind of the turbulent times from an interest rate perspective, but we'll give you kind of what we're seeing on the mortgage space side. We're going to look at budgeting for homeownership. What does it look like to go from renting versus owning? How is it going to impact me as I'm kind of preparing for homeownership? We're also going to talk a little bit about credit, how to have my credit in the best possible position to help me towards homeownership. And then I want to outline some different loan programs for you. So if you're thinking about homeownership, like what's the minimum down payment I'm going to need to be able to provide? How much do I really need to save up for? What are some of the characteristics that go into the guidelines of some of these programs? And then I want to talk a little bit about savings for homeownership. That's one of the bigger challenges for most first-time buyers is how do I have enough of a nest egg, if you will, to help me get to my goals of homeownership. We'll also look at first-time homebuyer programs that can help supplement some of the needed savings for things like down payment and closing costs to buy your house. And then we'll talk about the steps of homeownership. So after tonight's class, you may say, hey, Jason, I really want to learn more about designing my own personalized plan for homeownership. What are the steps going to look like to go from going to a class like this to getting the keys to my house? So I'm going to kind of walk you through the process for that and how you can start that journey by booking your free consultation with us to help design your path towards homeownership. All right. So that's what that looks like. Hopefully you find that useful for you. And hopefully there's 2 or 3 things that you can take away from tonight's class. Again, we're going to record tonight's class. So if you missed something, you can tune back into our YouTube channel and see the recorded version of tonight's class. For those of you that got a chance to put your location or where you're thinking about buying in the chat, really appreciate that. And as I suspected, we're all across the country from the ATL to Chicago to New York, California. We're kind of everywhere and in between. We've got Massachusetts representing. So that's super helpful for me as I kind of tailor some of our content for tonight. What's interesting is, when we're thinking about these different markets, they do have some similarities, but obviously they tend to differ from a price perspective. And, it does help us in terms of like, how do we help coach you on what home ownership might look like for you. So thank you for doing that. Let's go ahead and dive in now and talk through our class now. So let's first of all kind of launch into home ownership by thinking about, does it make sense for me to consider home ownership? Because for most of us, this is going to be one of the number one or biggest financial decisions we decide to make forthcoming. And so when we think about that big decision we're going to have to make, we also have to think about, what are the benefits that I can take away from home ownership? Because when we buy a home, it's not like making that same rent payment that I'm doing today, because you're basically essentially paying your landlord's mortgage today versus having the opportunity to pay your own mortgage and reap the benefits of home ownership. So what do those benefits look like? Well, I can create a little bit better budget for myself, because no longer am I worrying about that landlord that wants to increase my rents because maybe the average rents have increased in my area. Now I have a fixed payment that I can rely on. Even though I may decide to purchase today in today's market where interest rates are a little bit more elevated, there's probably going to be an opportunity for me to refinance in the future to bring down my rates. And we'll talk a little bit more about refinancing, because I get a lot of questions about that in class. But ultimately, refinancing allows you to bring down your existing balance to a lower rate product if the market supports that lower rate level. And this is an asset that's going to hopefully appreciate over time. It's an opportunity that as you pay down your balance and then as your home grows in value, that asset will now create home equity for yourself. And for most of us in the United States, that's our biggest asset that we have. And that asset has the opportunity to create generational wealth for ourselves as well. And believe it or not, there are actually some tax benefits that you can still reap in home ownership. So you have the potential deductibility of interest on a mortgage. Plus, as you make maybe energy inefficient improvements to your house or upgrades, that can also create tax benefits for your household. All right. So, that's really kind of an important point to think about when it comes to home ownership, because when we compare, let's say $2,500 in monthly rent versus $2,500 in mortgage, really doesn't look the same. And to illustrate that point, I want to kind of dive into a rent versus buying calculator just to kind of show you a little bit more about how that comparison looks for you. And as I mentioned, for those of you, I know we have a lot that are attending getting into class a little bit late, but as I mentioned earlier, I'm going to send out all this content to you tomorrow. So Ken from our team is going to push out an email with all of the slide deck from tonight's class. But this will also include some of these links that we're going into right now, which would include our rent versus buying calculator. So I want to walk you through this example. And then I would encourage class, if you have some time on your own, maybe to dive in this calculator, do your own kind of analysis, because I think it helps to frame things up when it comes to considering home ownership. So in our example here on screen, we have a client of ours that's considering, or that's, I should say, renting right now for $2,500 a month in rent. In that rental budget, they have $15 slotted for home renter's insurance. And then we're expecting their rent to increase 3% on an annualized basis. So that'd be my kind of my rental column, if you will. And then from a home ownership perspective, we'll kind of slide down here. We're going to assume that we're going to purchase a house around $425,000. I do realize we have a very diverse group in terms of communities across the country. So, 425 is going to look a little bit different in San Jose, right, than it's going to look in, say, maybe the Atlanta market, right? But this, the same kind of approach will follow for those markets. We'll just obviously have to adjust the purchase price accordingly. Of course, I would encourage you to do that on your own when you have time. But let's say we have someone that's purchasing at $425, minimum down payment of 3% on a conventional loan, which you'll learn a little bit more in our loan program segment. We have expected property taxes for a home at that value. We have $5,000 a year. We have homeowners insurance projections, maintenance cost projections. And so that would kind of go in our home buying side of the analysis, right? And then we also want to factor in things like, what's the loan details look like? So most first-time buyers are going to elect, say, a 30-year fixed mortgage product. We put an average interest rate of 6.75, which looks a little bit different than it did last week, but we'll talk more about that in just a bit. We have origination costs for my loan. So that's essentially how much am I paying my lender for closing costs to purchase my home. Now, one of your benefits as part of our Georgia Tech Alumni Network is we're going to actually discount our services by $750. So as you partner with our team for your financing, whether you're purchasing a home or even refinancing, we're going to provide you that added discount. Now, I want to explain this section here, which is called discount points. And some of you that might even be starting your home buying journey now, I've already started maybe talking to lenders. And one of the things that I found in my research with competing lenders is that a lot of lenders will showcase very low interest rates, but don't necessarily show you behind the scenes what that interest rate cost is, because you can pay additional funds out of pocket to bring down that interest. It's called discount points. And essentially, one discount point is the equivalent of 1% of my loan amount. And generally speaking, that 1% that you pay out of pocket will bring that interest rate down from, say, 6.75 down to 6.5%. Now, here's the challenge with that is that many of our clients buying in today's market are probably going to consider refinancing in the next couple of years. So to make an out-of-pocket investment like 3,000 or 4,000 or whatever the number is, it takes about 3 to 4 years to break even on those investments. So I really don't recommend clients paying discount points. So if you're seeing a ridiculously low rate online, it probably includes interest rate buy down or discount points, which again don't make a lot of sense in today's market. We have other settlement services, which would be our next section, and we're thinking about there is like title and escrow fees, maybe some of our local county charges that we have to procure my home purchase. And then we have the last section, which is going to be around the other assumptions I should consider with my home purchase. Well, we hope this home will appreciate, right? So we have an appreciation rate of 4%. Expected years in the home, we'll put it 7 years versus renting for the next 7 years. The cost of my selling my house at the end of 7 years. We have a state and federal tax rate. Obviously, that changes depending on what state you're going to buy in. And then finally, we also want to factor in the tax savings the savings rate of 1%. Now, that's obviously pretty light considering what the yields are today in savings accounts. Now, that being said, here's what our analysis shows. Well, if we continue to rent at $2,500 a month, that's obviously a much cheaper budget in comparison with the home buying side, which is like $3,600 a month. So we're looking at about an $1,100 difference or variance, right? But if I was to look at my total cost opportunity over the next 7 years of renting versus buying, it's going to be more positive for me to buy and essentially be able to save myself $94,000, or I should say be able to grow in $94,000 by owning my home over the next 7 years versus throwing that money away in rent, perhaps. And how I get to that 94,000 number includes some of my tax savings that we mentioned in the launch of tonight's class, as well as the appreciation in my home over the next 7 years, assuming about a 4% annualized appreciation rate. So, clearly homeownership can work. Obviously, budgets can change based upon what market we're going to buy in. But, I would say, if you have some time after tonight's class, take some time to do a walkthrough in that calculator, because I think it really helps to kind of frame up what potentially homeownership could look like for you. And of course, all the added benefits that come along with ownership. Now, let's take a little bit about the housing market today, because, there's a lot going on in the housing market. Now we're officially in spring. So we're in the spring and summer buying months, which essentially is the busier times of our year. So kind of the way the housing market works, we kind of start to see slowdown in October, November, December. Most parts of the country start to get a little colder, continues on into January, February. Then March starts to heat up a little bit, especially after Super Bowl weekend. We start to see consumer level of interest start to pick up a little bit. And then we start to move into the spring and summer buying months. Spring and summer buying is generally when more sellers are going to be more apt to put their homes on the market. More buyers are considering moving to a certain community, maybe because of school districts or a job relocation, whatever the case may be, right? And so that's why, we're right now, even though we do have some challenges economically, we're still seeing a lot of buyer activity out there. Now, in most markets across the country, we have a bit of an inventory challenge. So not a lot of supply to support the buyer demand, even though we're moving into this, spring and summer heavy buying months. Part of that is because most resellers don't really want to trade in some of their lower interest rate mortgage products they have. So some of those existing homeowners that, refinanced back in 2021 or 2021, latter part of 22 or early part of 22, have rates at 2.5% and 3%. And so it's very difficult to be a move up buyer in today's market and say, hey, I'm going to go ahead and sell my house today and put it on the market, go buy something bigger and better, and exchange my 2.5 rate for a 6.5 or 6.75 rate. So we do have some challenges as it relates to inventory in the market. Builders are trying to offset that challenge by building new homes, but cost of construction is up. So you're starting to see some challenges from that perspective. I do see in most parts of the country, though, sellers are starting to say, hey, you know what? I really still need to sell because I need a bigger home for my family, or I got to move to this different city because of my job transfer, whatever the case may be. So I think things are changing a little bit. I think inventory levels will start to increase a bit. Here's what we're seeing from a national perspective. So you can see the median sales price at 424. You can see kind of our trends in the market. You can see kind of an upward move here when it comes to purchase price. And then we kind of look at, how long are homes staying on the market? I would say most parts of the country, we're seeing a home stay on the market a little bit longer than usual. Buyers can be a little bit pickier at times. That will probably change. If I was to have a conversation with a client that's buying in San Jose, that might be a little bit different than someone's buying in maybe Dallas, because maybe those inventory levels look a little bit different by city or market, right? Now, buyer demand is generally going to be fueled by what interest rates look like. And while we're still at elevated interest rate levels, we still have high interest levels from many clients all across the country. Now, I mentioned to you as we started tonight's class, it's been a wild ride when it comes to interest rates over the last 5 days. And for those of you that are watching closely what's going on in economic news, tariffs are the big topic of conversation, right? Are tariffs going on? Are they not happening? How much the tariffs are going to be? What countries are going to reciprocally tariff our imported items or exported items? And so there's a lot going on the economy right now. I would say last week, you probably didn't want to look at your 401ks because the Dow Jones was taking 1,000 and 2,000 point hits. And today we had just a wild ride. Last Friday, so just 4 days ago, we had clients that were locking in rates as low as 6.3%. Well, that has been a complete reversal. Over the last 3 days, we've seen with kind of the uncertainty of tariffs, we've seen interest rates go the other way now. So the pressing of the tariffs pushed stock market down, which interest rates typically work inversely to what the stock market is doing. So if the stock market has a really rough day, then the interest rates generally improve. Well, the stock market, it was starting to rebound, especially rebounded today. I don't know where the finished close was, but it's well over 2,000 points. Interest rates were all over the board today. And unfortunately, interest rates have risen about 0.5% just over those last 3 days with kind of all the back and forth of tariffs. Are they on again? Are they off again? And of course, now it looks like we have a pause for 90 days. And so there remains a lot of uncertainty in the interest rate environment. I do think kind of long-term projecting out, we're going to see interest rates drift lower, but it is going to be kind of this very volatile in interest rate environment that we're going to see over the next several months. This environment today doesn't look well. The characteristics obviously are a lot different, but the interest rate levels look very similar to what we saw back in the early 2000s. So if you look at our chart here, this blue line represents the 30-year fixed mortgage, kind of this up and down here, but almost close to what we saw 20 years ago. Now, of course, we look at some of the major factors in interest rate volatility. We have the housing crisis here back in 2008, and then we have this line represented by the pandemic, and then interest rates fall here. Then we see this obviously swift move upward to interest rates, much of which is fueled by the Federal Reserve kind of raising interest rates to try to tighten up on inflation. And so, the inflation goal for the Federal Reserve is 2%. We're still off from that goal. We do have a big report coming in tomorrow called a Consumer Price Index report. That's one of those measurements that's used to kind of see where inflation is at. So that could be a market mover tomorrow for us as well. So, we are definitely kind of all hands on when it comes to interest rates right now, because it obviously changes buyer activity levels. But really, our goal is to create affordable home ownership for our home buyers, and getting that little difference in interest rate makes a huge difference from a payment perspective. Last thing I just want to kind of touch on here is just, what we've seen in the last 12 months. So as of Friday, we're at the lowest levels of interest rates in 2025. Well, that's, again, reversed itself a little bit today. So now we've kind of elevated back up. We're not anywhere at this level here, but we're just kind of right at that just below 7% level now, probably 6.75 as of today. But this will be a very fluid situation as we kind of see if we, what happens with the tariffs and the reciprocation of tariffs and whatnot that happens. But also we'll be looking really closely at what's happening in the labor markets as well as what's going on with inflation. All right. Now, when we think about interest rates, there's a variety of different characteristics that go into interest rates, like what my credit score is and the eligibility for certain programs I'm going to look at, the type of loan program I'm looking at, an FHA loan versus a conventional loan, how much I decide to finance, what my down payment might look like. We talked earlier about debt discount points where I could pay additional funds out of pocket to bring down my interest rate. And then, of course, the loan term will help influence my interest rate as well, too. So usually the shorter the term is of my loan, the lower my interest rate is going to be. Now, today's market, a little bit different, but ultimately the shorter I bring that term in, so if I go from a traditional 30-year fixed mortgage down to, say, a 15-year fixed mortgage, maybe that saves me 0.25% to about 0.5% in interest rate. Ultimately, as we meet and connect with you to design your own home buying plan, we're going to figure out the right program match, what the right down payment is, because ultimately that's going to translate into purchase price and monthly budget for you. And we can help advise you on really what the best situation is for you based upon some of your financial goals. All right. We're going to transition now into credit. Before I do, I just want to make sure I'm not missing anything in the chat. Any questions or in the Q&A that we can help answer from our audience so far? I do see a hand raised. So if you have a hand raised, if you want to just drop that question in the Q&A or chat, if you do have a question, I'll make sure I get the answer. Again, thanks for those of you that are you put your location or where you're looking to purchase in the chat feature. I appreciate that. And so I did have a question that came in, which was, I used the rent versus buying calculator briefly. Even at 30 years in the house, I saved more in renting than buying. What other questions or decisions do you consider to ignore the loss and cost savings to build wealth? And this is someone's looking in the Bay Area housing market. So the Bay Area housing market, so we're referring to the California Bay Area market, that it's a bit of an anomaly. So, especially if you're in a rent-controlled environment, or you just have a really great deal on your lease, it is at times tough to make that rent versus buying calculator work. And because if you're paying $2,500 in rent and you have to buy $800,000 or $900,000 to get into a market, that math is never going to work. But I think it really depends on financial goals. So for our audience member that asked that question, I would say, let's talk a little bit about that as a one-on-one, maybe offline, because, you may have a particular situation that just is not going to make that math work. But if you're looking to purchase for equity growth, for sustainability of future budget, homeownership could work for you. All right, thanks for that question. All right, let's talk a little bit about credit, because as we meet with our clients to figure out home buying plans, we're going to look at different credit reports or credit scores, I should say, and see how that matches up to some of the guidelines for certain programs. We want to help educate you on areas of opportunity within your credit to be able to help get you the best available interest rates, as well as different expenses that come up into the financing equation. So every loan program does have a minimum credit score. You can see those on screen here. FHA loan 580, conventional loan 620, our veterans product 620. And then for clients that want to buy in rural markets called the USDA, it's a 620 score. So every product will have a minimum. And then kind of our goal is to get to the highest level possible, because ultimately the higher levels we get to, we'll see reductions in interest rate and cost of expenses like mortgage insurance. Now, bigger factors like bankruptcies, foreclosures, short sales, collection accounts, those are going to have bigger impact or kind of a dragging onto the credit score. But generally speaking, when you've had major events on your credit score, even a late payment, it's probably going to impact your score in the most recent 12 to 24 months from the date of the event. One of our biggest areas of opportunity is credit utilization. We'll spend some time talking about that in just a bit, but essentially credit utilization is your balances versus your credit limits and how do we manage down credit card debt. We'll talk a little bit about account closures in just a little bit. We're talking about maturity of accounts, and when you close out a revolving account, specifically the takeaway from your actual credit reporting. There is 3 agencies, as we're all aware of. There's Experian, Equifax, and then there's TransUnion. Now in lending, I'm always going to look at the middle credit score of all borrowers. So if my highest score is 740, my middle score is 720, and then my lowest score is 700, from an eligibility perspective for that borrower, we're taking 720 for the qualifying score. Now, if I have a partner that's at 700, 680, and 660, well, the lowest credit score between the two of us is a 680 credit score. So then the 680 would be the score we would use from a qualifying perspective. Now, these are conversations we're going to have with you during your own home buyer consultation. But I think it's important to understand how we look at that, because a lot of clients will mention, hey, I'm going to have my family member co-sign with me to help improve my qualifying for a certain purchase price. Well, that's great, but if I'm still at a 680 middle credit score and my uncle is going to co-sign for me and they're a 740 score, we're still going to use the 680 credit score when it comes to qualifying and eligibility for products and interest rate options. All right. Now, negative items that will stay on my credit report, I think it's important to understand how long they're going to stay there. Things like hard inquiries and, late payments. The most recent 12 to 24 months is the most impact to the score. But in terms of how long they'll stay with me, you can use this matrix as a guide for yourself. I know the question that came up, which is, can you tell me more about a 30-year fix versus a 7-year fix or a 10-year fix conventional loan? What's the suggestion there? So in loan programs, you have 30-year fixed options, you have 20, 15, 10. Now, those are all fully amortized fixed options, but I think our audience member here is asking specifically about adjustable rate products, which would be fixed for 7 years, and then it adjusts based upon market conditions, and then 10-year fixed, and then it adjusts. So the payment is spread over 30 years, but in the first 7 years, it is just at a lower interest rate because it's an adjustable rate product. So there's some risk on that side. In a normal high interest rate market like we're in right now, well, that we could have been in, you could say, yes, potentially an adjustable rate could be a solution to be able to allow you to get access to homeownership at a lower payment level. But right now we have an inverted yield curve in the market where if you look at the 2-year treasury and the 10-year treasury, there's a very small gap between those numbers. And that leads to adjustable rate products not being super competitive. Now, there will be some credit unions out there that will do some kind of teaser products to get you into a relationship with them and maybe offer the adjustable rate. But in today's market, it's really hard to make the trade-off of going into an adjustable rate product versus a 30-year fixed product. All right, let's look at the modeling for credit. And for those of you that do credit monitoring, which is great, you're probably using Credit Karma or some of the other agency tools that are out there. Those are all fantastic. For the most part, they're probably using the credit card model to send you out your notifications and updates, which is nothing wrong with that. But it's not going to necessarily be the same lens that we put on from a mortgage perspective. So they'll have a different scorecard, if you will. So there's actually 3 different scorecards. There's credit card, there's auto, and then there's mortgage. So of course, if you're applying for home financing, we're going to use the mortgage model. I want to walk you through that model, and then we'll kind of give you some tips in one kind of more important low-hanging opportunity area. So the first one is length of credit, which is essentially how long have I had credit. What we're looking at there is the more mature my credit file is, the more improved my credit score can be. If you decide to close out an account, that will impact your length of credit, because when I close out a revolving account, it strips away all my history, all the maturity within my credit file. So we really want to be cautious in doing that because it's a 50% weighting in the credit score. And then how much new credit we're trying to access is 20% of the weighting. We're looking at new accounts that I'm trying to open up, inquiries that I'm making, hard inquiries to open up that account. Now, one of our approaches that we have, which is a lot different than most lenders, is because we primarily work with first-time buyers, we only do a soft credit check to design home buying plans and issue pre-approvals for our clients. And the reason why we do that is because first-time buyers especially have a longer cycle when it comes to going from meeting with us to actually getting in contract with the seller. So we want to provide you your options and resources without impacting your score. So that's why we always start with a soft credit check. All right. Now, this is our area of opportunity, which is amount owed. It's 30% of the weighting, and specifically, we're looking at revolving accounts for this area. And we're comparing our credit balances that we have outstanding on credit cards and revolving lines of credit versus the credit limits. So simply, if I had $5,000 in credit balances, I had $10,000 in limits. Right now, I'm at 50% utilization of my credit. Now, ideally, we want to be at 10% or less, so $1,000 or less on my balances. Now, if I'm a little bit higher today, maybe I'm at $8,000 in balances, my first opportunity level would be 50% utilization, so get to $5,000 in balances. My next level of opportunity would get to $3,000 or 30% utilization. And my optimized level would be to get to 10% and less. Okay, so that's how we would coach a client from a credit perspective. Now, how do I manage that down? Well, if you look at your credit card statement, you have two dates. You have a billing cycle date and you have a due date. On the billing cycle date, when that ends, that's when the credit card issuer sends out all your information to the three major agencies. Now, if you could change your approach on your credit card payments to pay them down or off before the end of the billing cycle date, you can catch that account before it reports to the agencies and therefore lower your utilization higher because you have a lower balance and, of course, improving your potential credit score. All right, so that's a big deal because that's 30% of the weighting. Next one is 35%. We're looking at kind of more of the legacy of payment history. Late payments are rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. Again, it's going to be really impactful in the most recent 12 to 24 months from the event. The more severe my late payment is, the bigger impact I'm going to have on my credit score. All right. So as we meet with you for a consultation, we're going to figure out where there is an area of opportunity. If you're at a 760 and you're trying to figure out, hey, Jason, how do I get to an 800 credit score? We can model out your credit during our consultation and show you exactly the steps that we would recommend or action items to get to that 800 score. Maybe you're at a 620 credit score and you're like, hey, I really want to get to a 640 because then I'll have eligibility for first-time buyer programs. We can help you with that in meeting with you. Okay. So what I tell clients when they decide to consult with us for home buying plans, it's not like send in your application, it's a pass or fail. It's more of meeting with you to customize options and ultimately work on a game plan because some of our clients are just not ready to go yet. Maybe it's some credit improvement. Maybe we haven't saved enough. Maybe we just want to know what a budget looks like. And those are things that we do a little bit differently in kind of consulting with clients. Now, one of the things we look at that show up on credit reports is student loans. And, for most of us, student loans that are federally backed are going to be in a forbearance right now because of kind of the pending litigation with forgiveness of student loan debt. So, you probably don't have an active income-based repayment right now because they're not accepting those. It does pose a little bit of a challenge from a lending perspective because we're not able to get the usual data points that we can get prior to this litigation to verify payment schedules for clients. So if you are doing an FHA loan by default, we use 0.5% of the balance as the payment. So if I had $75,000 in student loan debt and I had a 0.5% factor for an FHA loan, then I would have $375 used as my monthly payment to qualify. And then if I was looking at more of a conventional loan, it would be 1% of the balances that would be used as my qualifying payment. So even if I'm back in school and that's why my loans don't have activity on them because they're in deferment, or like I said, you're in forbearance because of the pending federal litigation, that still would require us to count a minimum payment. Now, I do still have clients that are in income-based repayments that, let's say, are now paying $250 a month on that same $75,000 balance. That's totally fine. If it's as long as it's an active repayment, then we can use that payment to count towards qualifying. The reason why we have to do that is because when we look at various loan programs for our clients, there's a set of guidelines that we have to underwrite to. So we have to kind of match up the qualifying against those guidelines. And every guideline is going to have some type of student loan qualifier to it. Okay. Now, those guidelines are centered around different loan programs that we offer. And during our classes, we like to kind of spotlight a few of those programs, give you kind of a high level look at those, and of course, answer any questions you have about some of these programs. So let me kind of walk you through just a 10,000-foot view of some of these programs. And the first one is a conventional loan. So when you think about a conventional loan, that's a Fannie Mae, Freddie Mac loan. You heard a lot about them in the housing crisis of 2008. But Fannie Mae and Freddie Mac house about 60 to 70% of all originations across the country. For first-time buyers, it's a minimum down payment of 3%, minimum credit score of 620, and then the maximum loan amount conforming loan is 806,500. So that's the conforming loan limit nationwide. Now, I know we have audience members that are joining us from other high cost of living areas across the country, whether in New York, Seattle, you're in Bay Area market in California. Those are considered high cost of living areas. So you can actually go under a conventional up to about $1.2 million. But when you go and finance more than 806,500, that minimum down payment, even for a first time buyer, moves from 3% to 5%. Now, anytime you put less than 20% down on a conventional loan, you have a thing called private mortgage insurance. We're going to spend some time talking about private mortgage insurance in our mortgage insurance segment in just a few minutes, but we'll talk a little bit about that in case that's on the minds of our audience. FHA loans, Federal Housing Administration is what FHA stands for. That is a government insured loan. Minimum down payment of 3.5%, minimum credit score of 580, and then depending on where you're at in the country, by county, there's maximum loan amounts. And so we have just a what if in here of 524, 225. But depending on if you're going to buy in the Atlanta market or you're going to buy in Dallas Fort Worth, they'll be adjusting maximum loan amounts. Now, about 2 weeks ago on FHA and USDA loans, the FHFA made decisions on how we have eligibility for those products. So if you're a non-resident to the United States, so not holding a green card or a U.S. citizen, you are not eligible for those government insured products as of May, essentially. So that's a big change. Something that we're still trying to get our arms around on, but that was the latest guideline change that we got just a couple weeks ago. We posted on our social channels to let everybody know. There hasn't been any changes with conventional loans with the new administration, but there looks to be a change coming on conventional loans. Some direct lenders and banks have privately kind of funded assistance programs. It looks like those programs will be not allowed under Fannie Mae and Freddie Mac. Now, the good thing is with our APM team, we've never offered any products like that. We do first-time buyer programs in partnership with different agencies across the country, but nothing within our own organization. But it looks like some of those that are offered by some of our competing lenders will kind of start to go offline. We can talk more about that if you guys have any other questions centered around that. Next product is a jumbo loan. That's for clients that need a little bit more funding capacity because maybe they're buying higher than the Fannie Mae and Freddie Mac loan limits, but it does come with higher down payments, 10 to 15% down payment, usually some higher credit score qualifiers as well. The VA home loan product is for our veterans that have VA home loan eligibility, zero down payment option, minimum credit score of 620. There really isn't a maximum loan amount for the VA loan product that was released about a year ago. And then this is just a veterans product, but it does allow flexibility for qualifying for the veterans. So when we look at things like expenses versus income, a lot more flexibility to encourage home ownership for the veteran, or maybe if there's some past credit challenges, a lot more flexibility or leniency from a guidelines perspective. The USDA product's our next one. That's a zero down payment option. If you're considering buying in more of a rural area, the benefit with USDA, it is a zero down payment option, has a minimum 620 credit score, very similar to FHA in terms of how they look at the guidelines as it relates to loan amount limits. And so that'll vary based upon the location. There are two qualifiers to the USDA product. We're looking at the location. So it has to be on the geography for USDA designated as rural. And then we also look at income by household. All right. So those are kind of 5 of the main products that are out there. We do also have a physician's loan that we just launched that we don't have listed here. That's kind of more of a boutique product, if you will, but essentially allows those that are practicing physicians, or if you're in residency right now, to be able to have some relief, especially when it comes to qualifying with student loan debt. So, we can talk a little bit more about that offline if you do have an interest in some of the physician loans, but that kind of makes homeownership a little bit more affordable for those that are kind of new in their practice. Now, PMI is something that comes up in our conversations with clients. So there's kind of a couple different ways of looking at mortgage insurance. There's PMI, which stands for private mortgage insurance. There's also upfront mortgage insurance or monthly mortgage insurance offered on government insured loans. Now, essentially what both aspects of insurance do is they basically protect the lender against default. So if you were to have any challenges as a buyer, the lender is essentially insured by a private mortgage insurance company, or if you're doing a government insured loan by the Federal Housing Administration. So let's take a look at this. So on the conventional side, PMI is based upon your down payment, what your credit score is, and then how much you finance. All right. So whether I put down 20% or 3%, that can change the calculation when it comes for mortgage insurance. Now, maybe some of you have already hopped on Zillow or Redfin and maybe have targeted a few homes in a community that you like, and maybe you jumped on their calculators to figure out a payment. more often than not, that mortgage insurance is going to show dramatically higher than what I'm going to share with you tonight, because it's not factored into some of these characteristics like down payment, credit score, and amount financed. Now, on a conventional loan, it does have a cancellation option generally. So once I reach 2 years in my home and I have 20 to 22% equity, I can apply to have mortgage insurance canceled. So let's say I bought a home with a $300,000 amount financed, and I had a 740 credit score and my down payment was 3%. My monthly mortgage insurance is probably about $92 a month. So if you did that same calculation on Redfin or Zillow, it probably would show as like 250 or maybe even 300 a month. So not as high as you might think. Now, as I raise my credit score up higher, maybe my score goes to 800, maybe I put down 10% instead of 3%, then that mortgage insurance starts to decrease even more. Now on FHA, it's a little bit different because it's kind of set figures regardless of my amount of down payment. So on an FHA loan, it's a 0.55% factor on the monthly side. And then I have upfront mortgage insurance, which is 1.75% of my loan amount. Different than conventional loans, an FHA loan, I cannot exit my mortgage insurance unless I refinance out of my home. Okay, so that's really important. So if I've had my FHA loan for 5 years and I had lots of equity, the only way I can get rid of mortgage insurance is by refinancing into a conventional loan. And for most of our clients that we support with FHA, it's more of kind of an entry point product to home ownership. Probably isn't going to be the forever loan for most of our clients. And so if we look at the FHA calculation, if I have my same amount financed as I do on the conventional loan at say 300,000, I have an upfront mortgage insurance premium of $5,250, so that gets added into my amount financed. And then I have monthly mortgage insurance, which is $137 a month. So, you know, you can see the difference obviously in FHA versus conventional, but I would encourage you to understand that, you know, not all clients will qualify in conventional, and it could be a variety of different reasons. It could be credit score, it could be the expenses versus income. But ultimately, we want to kind of figure out the right match for you from a product perspective and understand little characteristics like this as we kind of build a home buying plan for you. All right. So that's kind of a quick look into mortgage insurance. Before I talk a little bit about expenses versus income and some different income scenarios, when it comes to qualifying for home financing, is there any questions that I can help answer from the group? I know you guys have been great about putting those in the chat. Any questions before we jump into our next topic? Okay, all right, let's go ahead and talk a little bit about income. And so what we do in financing, we always kind of take a look at the income that we have, that it's reportable or validated income versus the expenses, I'm sorry. But we have to validate that income by certain pieces of documentation. And we gave you kind of a general checklist here. So usually, you know, last couple of years of W-2s, tax returns, pay stubs. And then, you know, on the asset side of the equation, we also ask for the last 60 days of asset statements. Now, when we look at financing, we look back at your work and or educational history. So we always have to verify at least 2 years of history. We don't necessarily have to be on the job for 2 years, but we have to look back the last 2 years. And so, you know, oftentimes when I meet with clients across the country, they may have thought they had to be on their job for 2 years, but I just ultimately have to report the last 2 years of work or educational history. So I may have graduated from Georgia Tech in the fall and just started my job January 1. If I can show my educational history coupled with what I'm now making on my new job January 1, that would make me eligible for financing. Even if I'm thinking about transferring jobs, maybe I have a job opportunity over here and right now I have an offer letter and I've only been on my current job for 6 months and getting ready to start a new job, you can still potentially use that new salary or whatever income structure you're getting to help you for qualifying. Now, in 2 years, the 2-year requirement comes a little bit differently when it comes to dual employment. So we do have some clients that work dual jobs, like maybe they work for one location for 30 hours a week and maybe 20 hours at another location. If I do want to include both sources of income, then I have to show that I've been working in both locations simultaneously for the last 2 years. If I'm self-employed, I have to have 2 years of tax filings in order to use that income. So if I'm a 1099 independent contractor, or if I own an S Corp business, then I still have to show that I have 2 years of tax filing in order to use that source of income. If I work on a salary position, let's say I'm making $60,000 a year, but I have some extra time on the weekend, so I drive for Uber on the weekends. If I want to count the Uber income that I'm generating as well, then I have to show that I've been working in both jobs simultaneously for the last 2 years. All right. And then another thing that kind of comes up from clients is that, occasionally we have situations where maybe we have a partner that's contributing to the household expenses or helping, cover some of those expenses, but does not want to be on the application. In that case, the only way to include my partner's contribution is if they're going to be part of the loan application. If I have room and board from a roommate right now, even if that roommate's going to transition with me to the new house, I can't really use that room and board income unless I'm looking at specific products that allow for a rental income. All right, so that's a quick look at what the income side of it looks like. Now, we also take a look at what do my expenses look like versus income. We call that debt to income ratio. It's a really simple calculation, but it takes a look at all my debts that I have today, my credit card debts, my personal loan, my car loan, my overdraft protection, whatever I have, right, versus my pre-tax income. And I have to add in my new housing expense. So if we're looking at a new home, I have my principal and interest of my loan, my property taxes, my homeowner's insurance, and let's say I'm putting 3% down, I have mortgage insurance. All that needs to be factored into the equation, along with an HOA fee if maybe I'm buying a condo or a townhouse that has those homeowners association fees. So generally, we don't want those expenses to be more than 45 to 50% of the pre-tax number, right? Now, if you're in a high cost of living area, sometimes we do see higher, we call debt to income ratios. The optimal level, I would say, is probably somewhere in the 33 to 36% range to be able to be in a really super comfortable zone. But the guidelines will allow us to go to 45 to 50%. So you can see we did kind of a what if scenario here. Someone that has a $2,500 housing expense, $500 in debt, and then they have gross monthly income of $8,500. If we take that expense versus income, right now their debt to income ratio is 35.3%. Okay, so those are one of the metrics we look at in qualifying for clients. Now, I will say it's not necessarily a metric that leads to affordability. Affordability is a different conversation because, you may qualify for a $5,000 mortgage payment, but affordability for you feels better at $3,500, right? And so ultimately, we want to make sure we design home buying plans that align with those affordability homeownership goals. Last thing I want to talk about on building a plan for you in our class is, before we talk about the process, is looking at savings for homeownership. Now, as I mentioned in the launch of tonight's class, that's usually one of our challenges for homeownership. As we're maybe new in our careers or maybe we're kind of trying to sift through some student loan debt, it might be a little bit difficult for us to save up for homeownership. Well, I'm going to give you a savings plan to take away in tonight's class. But before we do that, I want to kind of share with you again the acceptable sources of assets for down payment, which would include, of course, checking and savings accounts, 401k loans can be potentially used, brokerage accounts, and even gift funds can be allowed from family members. Now, all assets, with the exception of gift funds, require 60 days of seasoning, essentially meaning those balances have to remain consistent for the last 60 days. But if I have, my grandmother wants to help contribute to my home purchase, we can use those assets right away. There is a documentation process for that, which we can see here includes a gift letter, proof of the asset, and we generally have to show that you've received the asset, whether it's from a wire transfer or a check that was given to you. So that's all the kind of the acceptable sources of down payment. Now, let's talk about saving for homeownership. And we have to think about saving up for down payment, potentially the closing costs for my house, as well as what we call as prepaid items to purchase our home. So if I'm currently in a position where I feel like I can afford the mortgage payment, and let's say in this example we have on screen, we have a $3,000 what if mortgage payment scenario, but I just lack the savings to get there, right? And if I'm paying $1,500 a month in rent, the plan that I would consider putting in place would be to start today on day one, when I pay my rental payment, start saving like I'm actually paying a mortgage payment today, right? So on the first of the month, I make that $1,500 payment to my landlord, but I start carving out in my budget an additional $1,500 that goes straight to my savings account. And I do that for several months. For 6 months, I start now to accrue $9,000 in savings. By the end of the year, I have like $18,000 in savings. And it creates a couple different things. One is it creates the kind of the level of outgo that you start, it's not a big payment shock, if you will. So when you transition to homeownership, making a $3,000 mortgage payment doesn't feel like a lot of heavy lifting. And it creates that discipline, but also creates that rhythm of making that payment. And you see that savings grow, which makes homeownership, when you have $8,000 potentially a lot more feasible or more affordable for you than maybe if I have $3,000, right? And so that's what we try to encourage clients to do. Start that savings plan today. And budgeting obviously comes along with that too. So if I can cut expenses out of my budget, like maybe eating out or my Starbucks expense, that is obviously going to lead to better cash flow, which ultimately can translate to an easier move in savings. Now, in savings for homeownership, that could take some time, but first-time buyer programs can make homeownership a much more of a near-term goal. Now, there are a variety of different first-time buyer programs offered all across the country, and I know we have a very wide range of community audiences here tonight. So I'm not going to have time to go through all the different states that we have represented tonight, but I want to give you a general idea that there are programs available to you, depending on what state you're in. I would love to connect with you offline after tonight's class, and we can talk specifically about some of them. I've showcased some of them on screen here, like the national base product. This is more for low-income housing clients that make less than 80%. Most programs are going to be targeting families that make anywhere between 80% of the median income to 150% of the median income. We internally within APM have the Pathway DPA program. That's a nationwide program. It provides up to 3.5% to 5% of your loan amount for assistance. If you're in Georgia, which I know we have a few of our audience members in Georgia, there's the Dream Homeownership Program that can provide low to moderate income families up to $10,000 to $15,000 in assistance options. So we can certainly talk through that a little bit. I know we have California represented, so we just kind of spotlighted some of CalHFA programs. CalHFA is it's an agency that stands for California Housing Finance Agency. It supports low borrowing options and resources for low to moderate income households. You can get up to 3% to 6% in assistance for various down payment and closing cost scenarios. And for most first-time buyer programs, and specific to California, you can see slightly lower interest rate offerings on some of these first-time buyer programs. Again, I would encourage you, if you're considering, like I know we have one of our audience members in Maryland, and we have state of Washington represented. There's very similar options, and most states have HFAs available to low to moderate income households. The limits will change based upon, where you're going to buy in those states, but I'd love to talk to you about those offline. We're going to talk a little bit about the buying process in just a second. We got a few minutes left in class. I want to take one of our questions, which kind of goes back to our rate conversation we had earlier tonight, which is when we talked a little bit about the uncertainty in the market in driving up interest rates, are the fluctuations in market reflecting in home prices as well, or are home prices pretty much determined by other factors like school ratings, time of year, et cetera? It's a great question. So, the interest rates are going to be really driven off of what's happening in the uncertainty in the economy. Now, on the home price side, we've really seen home prices kind of still staying at stable levels right now. And I think it's partly because of what I shared with earlier. It's just we have a lack of inventory. So demand is still strong, even in a higher rate environment, but not as many choices for buyers. So I think, good old supply and demand, we have limited supply, still high demand. So it's kind of kept prices kind of stable. We've seen some cracks, if you will, and maybe that's not the right word, but some cracks in the housing market in certain areas where homes are staying on the market a little bit longer. Sellers are willing to make a little bit more concessions, kind of some more must buys or must sells, I should say, which can benefit our buyers. But I don't think by any stretch it's a buyer's market at this point. It's certainly still probably leaning more towards the seller side. But, we are seeing some, even in a Bay Area market in California, which tends to be one of our hottest markets across the country, we are seeing a little bit of home staying on the market a little bit longer than what we've seen in the last maybe year or two. All right. Okay, thanks for that question. Let's talk a little bit about the buying process, because I think it's important to understand, where do I go from here after tonight's class? Because we'd love to, first of all, get connected with you for a consultation, which is a free session we do all across the country to help design your own customized path towards homeownership. That output of that consultation includes what we call as a pre-approval, and that essentially really is the first milestone in the home buying journey. A pre-approval essentially tells a potential seller that you're fully qualified, shows the terms of your loan, the price that you're at, and for you, gives you the peace of mind as a buyer that you can confidently go out in the market and start shopping for homes. The pre-approval is usually good for 60 days, but it can be extended at any time. When you decide to apply with us, the application stays live for 2 years in our system. So like I mentioned earlier, many of our first-time buyers especially have a much longer buying cycle. So it's not like we're expecting someone to apply on Thursday and go out and buy a house on Saturday. It can take several months. Sometimes it takes even several years before our buyers are ready to go. And we understand that. So there's really no pressure to buy on our side. We just want to be a partner with you in kind of designing those options. Now, when you are ready to go and start taking those paths towards homeownership, that's when the fun part kind of kicks in. Now you get to start doing the house hunting. It usually starts online and then transitions to in person. We always encourage clients to partner with a realtor who should be a local expert in understanding that particular community, is an expert in negotiations, and has partners that they can utilize to do the proper inspection reports on a home. But all that would happen at step 2. At step 3, now you're a little further down the road. Now you've identified a property that you love, and then you want to decide to submit an offer to a seller. Well, if that offer gets accepted, then you're going to now be under contract to purchase that home. To go from step 3, which is entering escrow, to step 6, when you get the keys to your house, it generally takes 30 days in most parts of the country. Now, in some markets, we can go as fast as 14 days with our quick close program, but the general rule of thumb is 30 days, sometimes even 45 days in certain markets. Now, the day you get your accepted offer, I give our clients all a call and say, hey, congratulations, because that's most of the heavy lifting, is just getting an accepted offer for a home. And we'll give you a call and say, hey, congratulations. Let's talk a little bit more about next steps. And next steps would include, meeting with you to design your home buying options again, just to kind of recertify everything we talked about at the pre-approval stage, and kind of share with you a little bit more about your timelines that you've agreed to with the seller agreement. Now, you do have action items on your side as part of the agreement with the seller, which includes making an earnest money deposit for your property. It's called different things in most parts of the other parts of the country, but it essentially is an investment that you're making as a good faith investment to tell the seller that you have a financial stake in the success of this transaction. Usually that amount of money that you're contributing on the onset is 1% to 2% of your overall sales price. Now, that money will get counted towards your total out-of-pocket expense. And in most parts of the country, that deposit is protected by what we call the contingency period, which allows you as a buyer to do your investigative work. Things like get the house appraised to make sure it's worth what you're buying it for. Get your inspections done, like let's get the sewer tested, let's check the roof, let's check the foundation, all those important things. And those would be orchestrated by your realtor. Get your loan approved, which as your lender, of course, I will help you get your loan approved. And there'll be timelines, which generally will be somewhere between 14 to 17 days from day 1 of your contract, that allows you to do all that investigative work. Step 4 brings us to the administrative functions of the loan. We're going to do things like verify your employment, verify your assets. We're going to make sure your disclosures are delivered to you timely. There's 3 sets of disclosures that come out to you in the loan process. There's initial disclosures. So that's within 72 hours of your offer acceptance. And then once you get your rate locked in for your loan, you get another set of disclosures, and then you get a final closing disclosure, usually 3 days prior to the closing of your loan. Now, interest rates, which we spend a lot of time talking about throughout tonight's session, they vary, of course, daily in the market. Once you go under contract with a seller, then we're kind of like on the watch to make sure we can try to securely lock in your lowest interest rate. So just because I go into escrow or have an accepted offer on April 9th doesn't mean I have to lock in my interest rate that day. We can help you strategically navigate through the markets when we start seeing economic reports that are coming out that might be a little bit more favorable from a rates perspective. Step 5 is the loan approval. That's where we issue the loan approval. An underwriter has gone through and validated all your eligibility to the underwriting guidelines. By that time, we already probably have your appraisal back on your house. And we're starting now to prepare for the very final stages of the process, which includes issuing a final closing disclosure for you that gives you that 3-day cooling off period before we go to the closing phase. And you've also probably reached the end of your contingency period at step 5, which if you've gone through your investigative work with the inspections, your appraisal checks out, we have your loan approval, then you can communicate with your realtor your comfort level on now releasing those contingencies and telling the seller that you're ready to go to the final stages. And now at the final stage is step 6, which is now the last stage, and it's the in-person stage. So there's really kind of 2 in-person stages to buying. go out and find the house in person, and then signing loan documents in person. That process usually takes about an hour. On that day, in most parts of the country, you're going to deliver your final funds that you have available for your down payment, your closing costs. As a lender, we wire in the funds for the home financing as well as any assistance programs that you elect. And then those monies get reconciled. And then once they have been completed, then documents get recorded with the county recorder's office. They usually record a grant deed that transfers ownership to you as well as the deed for the loan. And after those things get confirmed, now you become the official owner of the home. Okay. And so that's what it kind of looks like from step 1 to step 6, going from classwork to like real time. Like this is really about buying a home. And, you know, on step 6, when we close the loan and now you get your keys to your house, that's the big day of celebration for you and for all your parties that are involved. And it's a big day for us too, because we get a chance to say, hey, guess what? You did it. You accomplished probably your number 1 financial goal of home ownership. And it's a big deal. And obviously we want to be there to celebrate with you. But our relationship doesn't stop there. So once you get the keys to your house, we want to stay connected with you as part of our aftercare program. So, you know, you may decide to buy now, and when refinancing makes sense, we're going to be connected with you through our rate watch program. So if rates drop 1%, we're going to be there for you. We also track equity positions with our HomeBot system, and we do annual check-ins with our clients. So that makes us a lot different, I think, when it comes to lending solutions. It's not just a transaction for us, it's a relationship for us, because let's face it, you know, in the financial cycle, things are always changing for our clients. We want to make sure we're there and top of mind with new resources for them. Well, we're at the top of the hour for class, and thanks to all of you for hanging in there for a lot of content tonight. If you're thinking about moving forward in the process, I'd love to be able to connect with you to help design your own home buying plan. I wanted to provide to you our Get Started information. It's a very simple process. It's completing your online application. It's only a soft credit check, like I said earlier in tonight's class, so we don't impact your score. You'll be required to upload certain documents, and then you'll use our scheduling link to schedule a consultation time that works good for you. That's a 30-minute session you do one-on-one with me. I meet with all of our clients through all of our workshops and that we do throughout the country. And so we'll work together to design an option, whether you're going to buy in Atlanta, San Jose, or Dallas, whatever market you're in, we can support you on your journey towards homeownership. But I would really encourage you after tonight's class, if homeownership is a goal for you, you know, allow us to see what options look like for you. And it doesn't have to be something you're going to be buying in the next 2 or 3 months. It could be a 2 or 3 year goal. But I think setting that goal gives you a higher probability of achieving that goal by knowing what the roadmap looks like. This is what our consultation looks like. Again, it's a free service that we provide to you. We want to understand, where do you want to buy? What budget are you looking to be at? Are there some credit opportunities? Let's kind of talk a little bit about what the timeline looks like for you, and let's just build a comprehensive plan. Want to point out a resource for you that's available on mobile. This is our mobile tool. You can start our application process there. You can follow the process of your loan through notifications that we push out to you. And what a lot of our clients do is they use the calculator feature within our mobile device, because when you're out at open houses, you may want to see, like, gosh, how much is that $525,000 house going to run for me? You can do it all via mobile and rely on that calculation. As we wrap up, I just want to point out again for our Georgia Tech alumni, since you're attending tonight's class, not only do you have access to our workshop formats, but we also discount our services for you, whether you're purchasing a home or refinancing. So we will discount our services by $750. And we teach over 55 classes throughout the year. We're going to do 4 of them for our alumni community in Georgia Tech, but we also have other partnerships across the country. So if you have friends, family, maybe some coworkers that you think might benefit from some of this content, we'd love for them to check out some of our upcoming classes. They can do that by checking us out at mortgageeducate.com. Here's all of my contact information. So if you do have some questions after tonight, I'd love to get connected with you. You can also use our scheduling system to book a call time if that's a little bit easier for you. And finally, you know, on our socials, not only going to see our tonight's class posted up on the YouTube channel, but you know, I think we try to put a lot of good stuff on our social channels that can help position you in the best possible light for home ownership. So we'd encourage you to follow us, so you can check us out at JMeda Mortgage. With that being said, I do appreciate everybody's time. I know I'm a couple minutes over time. I try to squeeze it all in, but I do appreciate you guys hanging out and enjoying hopefully tonight's class, and hopefully you have 2 or 3 takeaways from tonight. Before we leave and wrap up tonight's class, I want to just make sure we didn't miss any questions. So any questions from our audience that I can answer for you before we wrap up? Then I'm going to double check the chat, make sure I didn't miss anything. Okay, cool. We got that. All right, good deal. In case you're typing away. You're welcome. Thanks for that. Appreciate the kind words in the chat. Thank you for that. Okay. Awesome. Okay. I hope that's a sign that we were super thorough tonight. And I do appreciate you joining tonight's class. I do hope I get a chance to meet with all of you to help you on your path towards homeownership. I wish you all a great rest of the week, and I look forward to connecting with you soon. Have a good night.